Tesla dropped 4.8% today, landing at $422.24 per share. And the catalyst, according to Investors Business Daily, was a price hike. Tesla raised U.S. Model Y prices. That's supposed to be good news. Higher prices mean better margins, more revenue per unit. So why did the stock sell off hard? Because in 2026, after 3 years of whipsawing between cuts and hikes, Wall Street doesn't read a Tesla price increase as confidence. It reads it as a signal that something in the margin equation isn't working. That's what we're unpacking today. To understand today's reaction, you need the 3-year context. Starting in late 2022, Tesla began cutting prices aggressively, multiple times across multiple markets, to defend delivery volumes as demand at premium price points softened. By 2023, those cuts were deep enough that industry analysts described them as a structural reset, not a promotional tactic. Through 2024 and into 2025, Tesla selectively raised prices again as supply chains stabilize. Today's Model Y hike is the latest move in that cycle. The problem is that 3 years of price volatility has conditioned buyers. When consumers have watched prices swing repeatedly, the rational play is to wait. That consumer psychology, a cut might be coming, is a direct headwind to near-term volume. Here's the core financial tension. Tesla's gross margin peaked at approximately 29% in early 2022, per its SEC earnings filings. The price cuts that followed didn't just trim profits at the edges, they compressed margin per vehicle substantially. A price hike today, in isolation, looks like margin recovery. But the market's question is whether Tesla can actually hold that price or whether volume softness forces another reversal within a few quarters. That dynamic, raise price, watch volume dip, cut price to recover volume, watch margin drop, is the trap. And until Tesla demonstrates it can hold both price and volume simultaneously, investors are going to treat each hike as a setup for the next cut. The backdrop making this harder is a genuinely crowded EV market. In 2026, Tesla is no longer the only credible option at multiple price points. Domestic and international competitors have expanded model lineups, improved range, and cut their own prices. That competitive set gives consumers real alternatives, which raises the elasticity of demand for Tesla specifically. When Tesla raised prices in a less competitive market, buyers had fewer places to go. Today, the calculus is different. The risk isn't just that buyers wait for a Tesla discount, it's that some of them stop waiting entirely and buy something else. There's a second layer to today's move that the Benzinga coverage hints at, though it's harder to quantify. Elon Musk's attention is visibly divided. Reports today flag scrutiny of the SpaceX IPO structure as most management favorable, a governance concern that bleeds into Tesla sentiment because Musk is the connective tissue across his companies. When investors price Tesla, they're partly pricing Musk's focused leadership. Any news cycle that raises questions about where that attention is directed tends to add a small but real discount to the stock. Today had both, a contested pricing move and a headline about Musk-adjacent governance controversy. It's worth noting that today's Tesla drop isn't happening in a panicked market. SPY is at $739.17, and the VIX is sitting at 1843, elevated compared to the low volatility regime of 2024, but not crisis territory. This wasn't a broad market flush dragging Tesla down with it. The S&P held relatively steady. Tesla's 4.8% decline was stock-specific, which makes the signal cleaner. The market looked at the Model Y price hike specifically and decided it was a negative data point, not a positive one. That's a meaningful read. So what actually resolves the margin trap question? Watch for two things in Tesla's next earnings release: gross margin per vehicle and delivery volume. If Tesla can post a price hike quarter where margin recovers and deliveries don't fall off, that breaks the cycle. If not, if volume drops or margin stays compressed, then today's sell-off was justified. The market is essentially waiting for proof that Tesla has figured out how to raise prices in a competitive market without sacrificing the volume it depends on.